Hi there, my name is Nathaniel Perez, mortgage broker of Lend Financial Services, and let's talk mortgage. We'll be having 3 major series discussing credit: why it's used, how it affects your home buying, and how to improve it. This is a 5-episode mini-series that will help you, the person who's looking for finance, or your borrower understand the concept of creditworthiness. If you have anyone that needs help understand the concept of financial credit, have them tune in. I'm sure that after they watch our videos, the path to home buying will be much clearer. But let's start with a very simple question. Why is credit used? Well, not too long ago, banking was a very personal experience. If you wanted to borrow money, you would need to walk into a local bank and convince a loan officer to give you that loan. You would use essential documents and personal references to vouch for you. Today, if you want to get a mortgage, the only voucher that you have on your behalf to convince you can assume a loan is your financial credit. This gives banks a centralized source of information about your credit worthiness as a potential borrower. Credit bureaus and lenders use the 5 C's principles to gauge your credit worthiness, and these are capacity, capital, conditions, character, and collateral. This system is used to measure the financial track record and health of a client with the addition of the conditions of the loan that they want to assume. With this information, they will attempt to estimate the chance of default or the failure to pay off the loan when it's due. The first of the 5 C's is capacity. The lender must know that you, the borrower, can repay the loan based on the proposed amount and terms. This explains why the borrower needs to provide detailed information about their income, which includes the type, where it comes from, and if it's from a steady source. How do we verify these sources of income? Through income verification. This principle is not only used to verify income, but also measure your financial discipline by comparing your debts to your income. It is good to have a low debt to income ratio because it shows that you're financially able to assume the loan. So let's put this in a way more practical sense. Let's assume that you're in a pool with water. The pool represents your financial capacity and the debts represent the water level. The lender is the hose that puts in the water. The current water level is to your knees. If you ask for more water, they will gladly give it to you because you're safely able to assume that loan. Now let's assume that the water level is up to your chin. Ask again for more water, there's a high probability that they won't give you that water because you could drown or default in the loan. This is how lenders see you financially. Therefore, it is very, very important to have a debt to income ratio that is way below the lender requirements. I hope this helped you understand the importance of financial discipline. Remember, this by itself can determine if a borrower is eligible to even qualify for a loan. Well, this time next week, we'll be having our 2nd episode on capital. And as always, thanks for watching.